Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. AI sector shifts, market liquidity dynamics, and macro data. This video presents a direct informational narration of the source document. Today, we're unpacking a significant convergence of shifting market forces. We'll examine everything from AI capital expenditure constraints to a massive liquidity rebalancing. Let's get right into it. Our roadmap covers 6 distinct areas. We'll start with macroeconomic indicators, move through the changing economics of AI hardware and token usage, look at server costs, and finish up with market liquidity, options positioning, and corporate debt issuance. Section 1. Macro data and market context. We'll establish our baseline with the latest data from the U.S. labor market. For the week ending June 13th, initial jobless claims actually decreased to 226,000, coming down from a revised 232,000. Now, remaining below that 230,000 threshold is quite notable. It indicates that the labor market is maintaining a healthy baseline, coming in lower than anticipated. Meanwhile, continuing jobless claims experienced just a slight upward revision to 181,000 from 180,000. It's a very minor shift, suggesting that the broader employment picture is stable and doesn't present any immediate structural concerns. Section 2. Tech capital expenditure pressures. Let's pivot to the artificial intelligence sector, where we're tracking some significant supply constraints. We are observing 3 distinct pressures in hardware right now. First, memory suppliers are reporting that their 2026 production capacity is already full. This constraint might actually lead Apple to raise their end-user prices by up to 20%. Additionally, we're seeing domestic supply chain adjustments, specifically a new arrangement for Intel to design and manufacture chips for Apple within the U.S. If we look at the major tech companies driving this AI cycle, Amazon, Google, Microsoft, and Meta, they're approaching a critical inflection point. They've confirmed aggressive infrastructure growth through 2026. However, these sustained capital expenditures are starting to place real pressure on their free cash flow. The market is closely monitoring whether their high monetization rates can offset this, or if a slowdown is inevitable. Adding to these financial calculations is a major shift in the software landscape. The performance gap between closed-source flagship models and open-source local models is rapidly narrowing. Industry leaders have acknowledged this, and we're even seeing Microsoft actively evaluating self-hosted models like DeepSeek v4 right on its Azure platform. Section 3. AI token usage decline. This narrowing capability gap is directly impacting enterprise adoption. The cost breakdown here is striking. For complex tasks, a high-end, closed model might cost about $3.25 per task. On the flip side, local models like DeepSeek cost only 5 cents while delivering highly respectable performance. With that massive cost differential, we are seeing users migrate away from expensive APIs for their everyday standard tasks. Because of these unrestricted input costs, token usage data shows that enterprise demand for high-end models actually peaked back in mid-May and has fallen significantly since. Now that highly capable local models can run on standard consumer hardware, the market is effectively bifurcating. Section 4. Server cost and CapEx impact. So, how does this migration to localized models affect the underlying infrastructure? The immediate result is that data center server lease prices are plummeting. The industry is closely scrutinizing the return on investment for high-end AI compute. If the incremental return on each additional dollar invested in premium capacity isn't there, the pricing models simply have to adjust. This triggers a distinct sequence of events. First, high-end token demand drops. Second, localized model adoption expands. Third, data center leasing growth inevitably slows. And finally, this constraint feeds directly back into the broader semiconductor capital expenditure cycle. Section 5. Market liquidity and rebalancing. Now, let's pivot from fundamental tech economics to market mechanics, specifically looking at upcoming liquidity flows. We are tracking an extreme end-of-quarter rebalancing event. JP Morgan data indicates that pension funds need to sell off roughly $165 billion in equities. This is necessary to adjust their heavily overweight equity portfolios, currently sitting around 110%, back into their target bond allocations. Looking at the timeline, we recently passed the massive volume peak of the mid-June triple witching. Now, this $165 billion late June equity supply overhang is poised to dominate price action. That dynamic will remain in play until the new asset allocation cycle for target date and passive funds begins on July 1st. Section 6. Options positioning and debt issuance. Institutional positioning is highly technical right now, reflecting a very defensive posture. S&P 500 options data reveals that system funds are currently in negative gamma, which essentially means reduced liquidity provision. As a result, the index faces a slow, restricted grind upwards from the 7,500 resistance zone. Conversely, there is a downside vacuum, meaning volatility could be elevated until it stabilizes near the 7,350 support level. Furthermore, today's net delta was firmly negative. This was driven primarily by an increase in put buying. Traders are actively locking in their profits and adding downside protection rather than rolling their positions forward. Over in corporate credit, we're seeing some massive restructuring. SpaceX is issuing its first investment-grade bonds to replace a $20 billion temporary bridge loan that matures in September 2027. This move is a major step in restructuring their total $29.1 billion debt balance. In secondary trading, SpaceX is experiencing chaotic 50% daily turnover rates. The stock has established support near 180, but it faces massive overhead resistance, basically trapped supply, above 200. Given this highly technical dynamic, strict fundamental analysis suggests a valuation closer to the 100 level might actually be more rational. So, the question we leave you with is this. As we approach historic liquidity rebalancing, and as the AI capital expenditure cycle faces rigorous profitability tests against local open-source models, how will these converging macro and micro mechanics ultimately shape institutional allocations in the third quarter? We appreciate you taking the time to review this data with us today.